And speaking of something that might influence those tweeters, is exposure to private markets. In a way, you and I were talking backstage about the fact that exposure to private equity and private capital has been like the holy grail for retail investors for a long time. High net worth has sort of made its way in, especially in a more meaningful way over the past few years. Just yesterday, you guys, I believe, keep me honest here, announced a new fund really aimed at getting folks from a retail perspective into the private equity markets, the private markets. Tell me how that works and what that represents.
Yeah, so there's a fair amount to unpack there, and maybe just broadly, and it segues a little bit from what was talked about on the prior panel. If you look across the entire available investment universe and you just say generally traditional versus alts or publics versus privates and really start just delineating, what you see is that the alternative asset space generally is growing at a 2 times rate to the traditional markets. So roughly 10% per year compound annual growth rate. People expect that to continue for a decade plus versus 4 or 5. Mm-hmm. What's not in those numbers, but it helps support the growth, is structurally, alternative assets don't have to be in the market. So one of the challenges of investing in liquid markets is the fund structures themselves force you to take a view on a market through investing, whereas in the private markets, you can express a view by not investing.
Right.
You also can time your exits. So you can manage volatility much easier. And the fund structures don't have outflows. So when you go through volatile markets, you're not having to defend your existing positions and reallocate your book as aggressively. So there's a lot structurally that just sets alts up to grow continuously. So as a result of that, what has happened over time is we're generating pretty significant excess return relative to what I would call the public market equivalent. So private equity will generate consistently through cycles higher rate of return than public equity. Private credit will generally generate excess return relative to syndicated loans and high yield bonds and so on and so forth. So not surprisingly, putting aside what we all expect will happen over the next 12 to 24 months, we've been a 3-decade-long secular deceleration in interest rates. So every investor on the planet, whether you're an insurance company, pension fund, or a retiree who happens to be living longer, you need excess return and yield quite desperately in some cases. And so that's fueling this demand. It's really a hunger for that yield and that excess return in this interest rate backdrop. But now that people have experienced that excess return, we are seeing that demand be persistent. What you're hinting at is there's a new secular shift happening that's a combination of folks like Ares packaging alternatives for the retail consumer, and the large wealth platforms now rewiring the way that they're selling these products to access retail demand for alternatives.
Right.
And that is a little bit of a holy grail, not necessarily for us because that capital is available to us, but for the retail investor. Yeah. Because if you think about historically 10 years ago when we were selling product to retail, it was high net worth and ultra high net worth, and they were effectively tagging along with our institutional clients. Over the last 5 years, we now have credit product, we have real estate product, and now private equity product that mass affluent and true retail investors can access with partial liquidity, which is a real revolution in terms of their ability to consume what used to just be the purview of the institutional investor in the high net worth.
Right.